So we talked about income statements, we talked about cash flow statements, and finally there's another term in the next chapter that you've probably heard. It's a balance sheet. This is not to be confused with cash flow statement or the income statement. A balance sheet is essentially a snapshot of your business at any point in time, and it tells you how much the company is worth. It sort of tells you what the company has that's of value, what the company has that it owes to other people, and the final term, owner's equity. And as I write in this equation, this will sort of become clear what this is. Assets minus liabilities equals the owner's equity. So let's just do a very general example. Let's say you have $1 million in cash. Those are assets. That's a good thing. Let's say you have liabilities of $900,000 that you took out a loan and you owe someone $900,000. Do the math, you have $100K in actual equity, what your business is worth from a balance sheet perspective. So clearly this is a very important tool for understanding the value of a company and what sort of health it's actually in. The interesting thing that I think is worth taking another minute to understand about the balance sheet is that it can look confusing if you rearrange this equation. If you rearrange it and bring it over to the other side, you have owner equity and plus liabilities. When you look at it that way, you kind of think, why would liabilities be an asset? That seems weird. That doesn't look right when you rewrite the equation. But another dollar example with numbers will help explain this. So imagine you just started your business. Your balance sheet is essentially $0. You have no equity in the business. You have no liabilities. You just don't exist. You're just starting. And yes, 0 equals 0. Now, let's say you take out $10,000 to start producing lemonade. Maybe you buy $10,000 worth of lemons. We're not even going to get that far. Let's say you borrow $10,000 from someone and your intention is to go buy some lemons. At that point, you've got $10,000 in cash. You have a liability of $10,000 that you owe to whomever you borrowed the $10,000 from. And turns out you have 0 equity in your business because you haven't actually started selling or making lemonade or doing anything. But you can see that the equation works out. 10K equals 10K. So your balance sheet is correct. That's kind of why liabilities in this equation, though it doesn't exactly look right initially, that's why it works that way. And you could see, obviously, if you were to use this equation, which is the same equation, just rearranged, 10K minus 10K equals 0. So there is so much more to balance sheets than this, but I think it's a great chapter because it gives you the idea that it's actually really just a simple thing. Describing what an asset is what gets super complicated, and describing and accounting for liabilities and equity can obviously get extremely complicated, but at a very high level, the concept of a balance sheet is somewhat simple.